One thing we tell you to be on the lookout for when making your investment decisions is cost, because they could eat into your overall rate of return. In some cases, so-called low-cost investments may actually cost up to, get this, 4.1%. I'll tell you more about that just in a moment. First, let's talk about exchange-traded funds. We call them ETFs for short. These are securities that track an index or a commodity or bonds or a basket of assets like an index fund, but unlike mutual funds, they're bought and sold like a common stock on the stock exchange. ETFs are popular with index tracking investors, and they tend to have a reputation as potentially efficient and low-cost vehicles. With ETFs, many people think of market cap weighted ETFs like the S&P 500, which have an investing mandate to buy the largest company stocks and then work their way down. By paying attention only to size, important things like company fundamentals may get pushed out of the picture. What this can lead to is investors owning shares of companies by way of an ETF that, had they looked at each of these stocks individually, may have taken a pass based on their underlying fundamentals. I came across an interesting article recently that highlights this point. Check this out. According to research published by Pension and Investments newsletter, there are two factors that contribute to an added cost that investors may not be aware of. First, there is the cost of dilution in stock price relating to the company's executive compensation plan. Second is the cost relating to the annual share buyback programs of certain companies. What the article is claiming is happening is that certain companies may be issuing annual share buyback programs to offset the dilution of their executive compensation plans. Together, the author calculates that these expenses could add up to an average of 4.1% annually to the costs of owning an index fund built to mimic the S&P 500. Would you invest in a company if you knew your performance could be dragged down by 4.1% annually? Well, this isn't to say that ETFs or index funds are bad. For the appropriate investor, however, they can potentially add value, and we do use them in our portfolios. What we prefer, however, is factor-driven strategies that focus on fundamentals over market cap-weighted strategies. These can be in the form of passively managed ETFs or even actively managed individual stock portfolios. The point is that it's not necessarily the size of the company that matters, but rather the underlying fundamentals.
ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing.